Next up is how big data is reinventing global finance. Please join me in introducing Spencer Greenberg of Rebellion Research and Matt Quinn, the CTO of TIBCO. Please, Spencer, Matt, come on out. Great. How you doing?
Good. How are you?
Good.
Hello.
Hello. Gentlemen, the last 3 years have been a bit troubling for the world. Your customers, or you yourselves, are responsible for blowing up the entire global economy. This is the softball question. We're going to make it harder later. Finance is a black box for most people. In fact, it's a black box for most people on Wall Street as well, not just people on Main Street. And you folks, both of you, represent the alchemists who know something about what's inside that black box. So I think the place to start is to find out what it is you guys actually do for a living. Spencer, why don't we start with you? Who are you, what do you do, and how are you different than the other people who do similar things? You're a quant.
Yes.
Tell us what that means.
Well, so my background is in mathematics. What my firm, Rebellion Research, does is we apply artificial intelligence methods, specifically methods known as machine learning, to doing stock market investing and investing in other asset classes. And so you asked me to talk a little bit about what we do versus what other people do. So typically when people think of quantitative investing, they think of these trading machines that are operating at extremely fast speeds, sometimes on the order of milliseconds, making decisions in a way that is typically fundamentally different from the way that humans make decisions. It's a completely different ballgame from fundamental investing. Our approach is actually very, very different from that. We're much closer to a fundamental investor, even though we're purely quantitative. And so the approach that we use is we try to get machine learning algorithms to learn how to do fundamental investing, value investing, growth investing, momentum investing over the long term.
Good.
Yes.
Let me stop you right there. You're using the term machine learning.
Yes.
It's come up once or twice, but not in any real concrete way. Tell us what machine learning is.
So I'm glad we get to talk about this because I think talking about big data without talking about machine learning is a huge problem. So machine learning is a branch of artificial intelligence that's about getting computers to learn automatically from data sets. So the basic approach, how it works, is your machine learning algorithm has a set of hypotheses. So I'll give you an example. Imagine I wanted to design an algorithm to learn what tea you're going to like, right? And I have a data set of teas that you've drank in the past and properties of those teas, for example, whether it's sweet, whether it's green tea, and also whether you like the tea or not. And I want my algorithm to learn to predict which tea you're going to like. So the machine learning algorithm starts with a set of hypotheses. For example, it could be you like a tea if and only if it's a green tea. Or you like a tea if and only if it's chai, but not if it's iced. But you also like red teas, but not from South America. So it has a very large set of hypotheses. And what it's going to do is take the set of hypotheses, compare it against this data that we know about you, and figure out which hypothesis best fits that data. So for example, if it discovers...
So who's written the hypotheses? The machine hasn't come to it on its own. A human being has coded that in.
That's right. So however, we're talking about extremely large set of hypotheses. Sometimes all hypotheses over the set of properties you know about what you're predicting.
Sure.
So you start with this huge set of hypotheses. It processes the data, and it picks out the hypothesis that very well describes that data, taking into account some kind of Occam's razor, preferring simple ones over complex explanations.
OK. We use the term machine learning, but that's a little bit inexact. The machine's actually not learning. The machine is just simply making statistical correlations and coming up with a probability that I would like things. It's not learning per se. It's just simply calculating. It's just high-end math.
Well, I would argue that our brain is calculating.
Right,
indeed. Ultimately, our brains are algorithmic as well. So if one day we unlock the algorithms in the brain, we'll probably say, oh, we weren't learning. All we were doing is running an algorithm that correlates inputs and outputs, right?
OK, very good. But that's right. I want to suggest that it's not machine learning in the sense that Skynet is going to destroy us.
Right. This is what we call narrow artificial intelligence. It's artificial intelligence.
Matt, by the way, is right now either laughing or wincing. We'll get to you in a second. Okay. You can laugh and wince. I do to myself as well. Yeah.
So narrow artificial intelligence is what we have today. And that's about building machines that are very good at specific prediction tasks. So for example, predicting what tea you're going to like, or predicting whether an email is spam or is not spam. What you're talking about is general artificial intelligence, which is a whole other beast.
OK, very good. Okay, Matt, your turn.
Yes.
Yeah, TIBCO,
Yes.
powering the real-time economy, 2-second advantage. What do you guys do?
Well, I think kind of at a very simple level, we help companies, big and small, to deliver the right information to the right place at the right time. And what we've discovered is that oftentimes a small amount of the right information a little bit beforehand is actually worth more than all of the information kind of 6 months after. And I'll give you an example. Is it better to know that a customer is unhappy and perhaps going to leave a retail bank before they leave or after they leave? Yeah, is it important to do some risk and portfolio analysis at the right time to get a little bit of insight into what's going on before or after a major correction? And so what we try to do is allow customers to suck in all of this real-time streams of information and start to try to anticipate the patterns of events that may lead to something more important. And that could be an opportunity, or it could be a threat.
So should I blame you for the global financial crisis?
Sorry?
Should I blame your software that you didn't anticipate the global financial crisis?
We are just merely the platform.
That doesn't exonerate you. So what's happening in finance? Why are you here? How are you doing something special with big data?
Well, what we've found is that when you look at big data and you kind of look at what's going on in financial services, in some ways, global finance was both ahead of the curve when it came to big data and also perhaps a little bit a bit behind. And so, especially in things like capital markets and looking at high-frequency trading, there was a lot of focus around kind of volume and velocity. So lots and lots of volume, lots of speed, and there was a big focus on quants creating algorithms to take advantage of arbitrage opportunities. Well, that's all good, but what you've found is that, in fact, just looking at market data, for example, is not always a great indicator or a predictor of potential trading success. And that you actually need to look at both historical information and massive volumes of historical information and blend it with that real-time information to gain some insight into actually what's going on. Oftentimes you've seen that pattern before, you've seen what's going on before. Can you anticipate some of that and perhaps correct? And what I like to think of is, instead of making one big correction, let's make thousands of little corrections over a period of a trading day or a trading month or a trading year.
Do markets become more efficient, or do they become more volatile if we do this?
What we've seen is that, look, as these types of systems have come in place, and big data is not just for looking at in the capital markets, it's also applicable outside of capital markets in retail and wholesale banking and other places. And what we've generally seen is that if you have better context, right, if you really understand what's going on, and you're not just simply guessing based on a couple of vectors that you happen to have access to, that it actually can reduce volatility because there's a lot more understanding. Now, there may be more volume, but it can actually even things out over time, right?
If I may respond to that.
Yeah, go for it.
I think that if we're talking, let's talk about the stock market, because that's an area I know well. If you're talking about the stock market, the question of whether you're adding volatility or reducing it actually depends on a lot on the type of strategy that you use. So for example, imagine that you have a strategy that tries to detect when the market is being irrational and basically bet on what the market will do. So you think that people are irrationally afraid and therefore are going to start selling, and your algorithm therefore starts betting against the market. Well, you're actually exacerbating irrational behavior. You're pushing it in the same direction as the irrationality. Whereas suppose that you're taking a more fundamental, like value investing approach, for example. You're going to wait for times when the market's irrational and has offered you discounted prices, and you're going to bet in the opposite direction. You're going to push things back towards more rationality. So I think that there's, you really have to talk about what types of strategy you're running.
Okay, fair enough. There are lots of firms, lots of funds out there trading using a variety of different strategies. But markets rely on two factors: fear and greed. And when markets start going south, people start panicking. And we saw that on, what was it, May 10th, 2010, the day of the flash crash, when market volatility dried up. or market volatility spiked and volumes dried up because all the market participants said, oh shit, and got out. When are we going to have the next flash crash because of you guys?
So that's the question of when it's going to happen is an extraordinarily hard question. But just to address for a second the relevance of the flash crash to something like what we're doing, it's about as relevant to us as it is to Warren Buffett. And when you're holding stocks for many months or years, what happens in one day or 1 hour is pretty much irrelevant. I do think we really have to be concerned, though, about systems that can trade millions or hundreds of millions of dollars in minutes, because those systems, when not checked by a person, could potentially go out of control, especially when you start getting complex interactions between lots of algorithms. So you may have tested your algorithm in normal conditions, but what happens in really crazy conditions when it's interacting with other algorithms that may be acting in ways you don't expect?
That's exactly what I'm wondering, which is I should have said it more bluntly. It's not just about the risk of any one individual or the malfeasance of any one individual actor, but systemic risk, because you're all basing it on algorithmic trading of some variety. You're doing it in the long term. Your other persons are doing it in high frequency trading in milliseconds. And you're part of the infrastructure that's powering that.
Yeah, but I think that things are changing, right? So I think that what you've got to look at is you've got to kind of look at what's gone over, especially over the last couple of years. What you've seen is you've seen the kind of the role of the quant, the person who's putting together these trading theories, if you will. They're looking for that trading signal. You know, they've started to look more broadly than just simply market information. And this is where it starts to get very interesting, because you're not just looking at a very narrow set of data. What you're looking at is you know, you're looking at Twitter feeds, you're looking at news items, you're looking at historical analysis, you're looking at massive volumes of information and trying to get an understanding of what's going on. And so before, I think part of the challenge with algo trading and high frequency trading was everyone was trading, but it was very narrow band. It was arbitrage opportunities, really based on things like time, like can I get faster to the market? Can I make that trade, or lots and lots of little trades, really, really quickly before the other guy does? Now they're getting more sophisticated, and so now I don't think you're going to see those swings around because of the sophistication of these algorithms, really looking at a broader context, which is what we want to kind of see in the marketplace.
We have built up a huge body of regulatory law presuming human motivations, and algorithms don't have that. So it poses the question, how do we regulate a world in which we have these black boxes, algorithms that are making decisions that we don't really know because the rule base for those decisions are so highly complex?
So we're starting to see some of this, and there's actually some interesting technology challenges at play here. So for example, you know, you can look at regulations from an analysis point of view, which is, you know, if the government asks you in 3 years, what was your trading strategy from 3 years prior, right? What did it look like? You can't just simply give the algorithm. You've also kind of got to give the data that you were basing that algorithm off, how you were training the algorithm and how you were understanding basing some of your theories off. And so there are some technology challenges with just simply storing and being able to replay those trading strategies at any time. It's for the government to kind of take a look at and say, okay, that was fair.
Can they actually do that?
I think that people are starting to build the infrastructure knowing that this is going to happen. And we've already started to see this in places like risk and portfolio analysis, where, you know, you have to kind of store some of this information. You have to be able to tell people, this is why I decided to manage my credit risk in this particular way. This is how I value my assets on this particular day, on this particular trading period. Now, I think that if you start looking at that from a high-frequency trading perspective, it gets even larger amounts of data.
Is it getting so complex that it's going to get to the point that it's going to be impossible to explain to anyone why a decision was made? And I'll give you a parallel. The patent office used to ask for models for things, and they still want diagrams, and patent applications used to be on paper. But then with biotechnology, you were getting 8 billion pages worth of material that was prior art, et cetera. For a patent application, it was too big. Do you see this happening as well?
Look, I think there's a couple of different ways you can kind of look at this. I think that at any period in time, if you really distill these algorithms, if you really look what's going on, usually they're quite simple, right? They're looking for very simple repeatable patterns, because they don't want to just look for the big trade that's going to make them a lot of money. What they're really trying to do is they're looking for lots and lots of smaller trades, right? Yeah. Which is why you're seeing the volume with high frequency trading. So I don't think that we're even close to that. I think that what you've got to look at is actually what they're basing the algorithms off. The amount of big data that is being analyzed to come up with these trading strategies, right? Being able to look at it and say, if I play this algorithm back, what happened over the last 10 years? It's that data that's becoming harder and harder to manage, which is why we've seen this explosion in technologies that manage big data.
Yeah, I would disagree slightly in that.
Before you disagree, sure. Everyone come up with your own questions, because I'm going to turn to you in just a minute. Disagree.
I would say that some of the algorithms that people use are highly complex. And one thing that differentiates the way humans make decisions from the way that machines make decisions is that humans tend to focus on just a small number of factors. It's very hard for us to take into account 200 factors simultaneously. Typically, what we'll do is we'll try to focus on the few that seem most important to us. Machines can take into a large number of factors, and that's certainly an advantage when it comes to certain type of decision making. For example, you could have a large number, 200 variables, all correlating a small amount with something you're trying to predict, and you could potentially make a robust prediction from that, but it would be difficult to back out exactly how that decision was made, because you could say, well, these 75 factors were positive, and the remaining ones were negative, but the overall effect was that it was a positive decision.
Does that scare you?
I think it depends on the application. I mean, these algorithms allow us to make, potentially, some of the machine learning algorithms allow us to make better predictions than any other methods that are out there. And so, yes, they can be difficult to understand at times, but they also can be really powerful tools that we can leverage greatly to our advantage. So I think that, fundamentally, to make good predictions, sometimes you need to take into account hundreds of variables.
I'm still totally unsatisfied by that, and I'll tell you why. Because hundreds of variables reminds me of the Library of Congress, which is like if you wanted to look at every single card catalog of the Library of Congress, just sit down and go through each one, and you actually can. And then think of the global internet. And if you wanted to actually just click through every single web page of the global internet, you absolutely couldn't, because you've increased the scale by such an order of magnitude. Sure. What if it's not a couple hundred? What if I said to you, I created a meltdown of the markets because of my algorithmic trading strategy. It's based on a number of predictors that I've correlated that actually would theoretically be profitable trades. But I can't explain to you exactly what it is, because it's based on 6 million different predictors, and the top 5 predictors together is just 1% of the overall predictive capacity.
Right. So let's take an example where this kind of problem actually occurs. A spam filter, right? How many words are there in English? I mean, there's more than 100,000 if you consider, certainly if you consider idiosyncratic expressions and things like that. So basically, they have to learn about over 100,000 different words and how they relate to whether something's spam or not spam. And in any given email, there could be hundreds or potentially thousands of words, and they're trying to learn from all of this simultaneously. Not to mention, it matters who the sender is, what email address it's coming from, so that's another thousands of variables or tens of thousands of variables. So, and yet they're able to build spam filters that work extremely well, basically by applying machine learning algorithms to process this incredibly large data set with an incredibly large number of variables. But the key is that they're able to test the reliability of those systems. I mean, that is really the essential thing, is that you have to check the validity of the system, and that's how you gain confidence in it.
And so we see it a little bit differently.
To gain confidence in the validity of a spam filter system is immensely reassuring to me. To gain confidence in the reliability of an autopilot system of an aircraft based on an algorithmic predictive model is a little bit scary. And the fact that we've had economic models for financial risk of subprime mortgages that went haywire for a black swan event is devastating to the entire world. Almost no one of the 8 billion people on Earth have not been affected by what happened by 10,000 people on Wall Street and in London. Right. So it's interesting, this question of the dangers of machines versus the dangers of humans. And I think, talking about the financial collapse, you had machine problems, and you also had a lot of human problems. It's different types of problems. So, and it's interesting, this question of to what extent can we control the machine problems, but also to what extent can we control the human problems. Matt, I cut you off, please.
So look, I can kind of see where that is going, but for us, I mean, what we've seen, especially in kind of the markets, and also, again, not just in the markets, but also kind of outside in the kind of the retail banking side, is that what's important for a lot of those is it doesn't take a huge amount of the right information, right? Part of the challenge that you've got is, looking at 9 million different vectors and 9 million different attributes I think is still going to end up with a little bit of a mess. Right? I think the trick is trying to understand at that particular moment in time what are the most important things. And for us, I think what we've been trying to kind of forge toward is what's the context of what's going on at the moment. Look beyond just simply market data. Don't just satisfy yourself with what's going on from an exchange perspective, but look outside at other factors and find those ones that are the most important and really look for those, both on the trading side, but also just as importantly on the portfolio risk management side, on the asset management side, and what products and services will keep my customer happy. I mean, all of those technologies can be applied for different things, keeping kind of the system in balance.
Okay. I want to just say you guys are great for kind of allowing me to sort of lacerate you as if I'm tarnishing you for causing the financial crisis. I know that you're not, and I'm pleased that you're willing to play the victim for the purpose of understanding these issues better. Turn up the house lights and let's see if there's any questions from the audience. I see one right there, please.
This idea of algorithms acting on their own has come up over the past day and a half, and that they may be black boxes. But all of these algorithms are conceived by human minds. The symbols they manipulate represent ideas in the mind of a programmer or mathematician at some point. Would it be possible to have code around these algorithms that document not just their outcome, but the meaning of what that calculation at that moment says? Something that says, here is the correlation on which the algorithm recommended an action. Here is what this correlation is deemed to mean in the minds of the people who created the algorithm. Is that possible?
So there's a couple of different answers to that. Most of the systems that we've ever seen in this space, or really in the big data analytics space in general, are trying to do this. Some of it's very, very rudimentary. I'm going to generate a log file or a log entry that kind of gives a snapshot of what's going on. Some of them are very, very sophisticated. Oftentimes, that has a lot to do with regulation, right? If I take an action at that particular time, am I required to make sure I store that action, the input and the output, in a secure place? And we're starting, I think, to see more of this, both inside of financial services and also outside of financial services. What's important, though, is people are not just doing this because they want to do it, because they want to learn as well. They want to look at the catalog of the actions that have been taken over the week, because that is itself another form of big data that they want to analyze. It's a little bit of a circular thing there, but it's very, very important.
I'd like to respond to that briefly, too. I think that's a very good question. And there certainly are a variety of techniques people use to try to back out an understanding of what an automated system did. But I think there's an important point to be made here, which is as the systems become more genuinely intelligent, it's a fundamental issue that it will be harder to understand the decision. Imagine trying to understand the decision that a human made by dissecting its brain. I mean, essentially, as things scale up to higher and higher levels of intelligence, the decisions become more and more complex. They end up hinging on more factors generally. And ultimately, eventually, at some point, when a system's intelligent enough, it can be quite tricky to understand exactly why it made its decision.
Why don't you ask the system like you would ask a human? Why did you make that decision?
Good question.
Well, I think it depends on what level of intelligent machine we're talking about. I mean, at some point, it might be that machines get intelligent enough that you could actually query the system and ask it in some kind of semi-natural language. Today, we're still at the point where querying it to ask why it made the decision will involve basically looking at the parameters that your machine learning algorithm has learned, or look at the hypothesis that it's generated. And certainly that is what people do today.
But that's just operationalizing or mechanizing the first question, which is, can we encode the basis by which the machine made its decision? Yes, we can. We have. Now we're querying that.
Yeah, I mean, if I look at some of the systems that we have around, and being able to correlate through rules and other mechanisms, real-time information. You know, the cache of data that it's basing its rules off, its decisions off, is queryable today. And we have customers that are doing, you know, sometimes simple, sometimes very complex impact analysis on what's actually in that cache, not just what's outside. So I think it's possible. I think it's the size of that where it becomes a challenge, and how quickly it's changing.
Great, thanks. I'd love to chat more about this, but we can't. We're out of time. Thank you very much. Join me in thanking the panelists. Good.